Hello, everyone.
Great to see you all. Oh my goodness. Look, I think we have got such a lovely time today to talk about some of the lessons that Chris and I have experienced with the lessons from training traders. We have got combined 50 years experience with trading trainers. Now, how does that work, you say? Because surely I don't look more than 20. But we're going to go there because our mentor program's been running for the last 24 years. Chris Tate started out as a flawed trader, and I'll tell you a little bit more about his background in just a moment. I started trading in 1990 and I left my job to be a full-time trader in 1996. So there has definitely been some water under the bridge since we both started trading.
You're making us sound old. Stop.
So Chris is the author of The Art of Options Trading in Australia and The Art of Trading. He's Australia's first author of a book on the stock market, which is pretty incredible if you look at that. I'm the author of 6 books on the Australian stock market, and my latest one's just been out for 3 months, which is Investing Psychology Secrets, which has just got to such a good launch here. It's just been wonderful to see. But let's have a look at some of the things that we can do to stay in touch. Now, everybody with the phone, scan here now because you're going to get a chance. You'll thank me. You will thank me. You're going to get a chance to win a free trading pack, and I'm going to show you exactly how this is going to work. So scan there, enter your details into that little registration box, and then you'll be able to get the chance to win either our Quick Start Trading Pack, and that's $2,600 in value, or our Professional Trader Pack. And I'm going to draw this after the event. So you are going to be in a very elite group of people that are going to get a chance to win one of those packs. And I know you'll love that. So make sure you enter the draw right now. Okay, now let's kick off Christopher. Now, Chris and I have been working together for half of my entire life, which is pretty staggering, really. And also, we do have our own AFSL. So that's our details there. I'm expecting you all to memorise it. Basically, it's saying that we're qualified to be able to discuss general advice. Now, let's start talking about psychological fitness. Now, psychological fitness is our resilience. How do we handle the blows in the market? How can we withstand the storms that come our way? Now, the research says the people with the greatest levels of psychological fitness make the most money in the markets. Now, that is pretty incredible because it is something that we can develop. It's something that we're not just born with, but it is something that you can grow into. Now, I wanted to start with this as a topic, Chris, because with the interview that I'm doing with you, mainly you're going to be answering the questions, but I'm going to be adding in my bit here and there. So how can traders stay psychologically resilient during markets ups and downs?
There's 2 components to this. One's macro, one's micro. One of the problems that people have with trading and with understanding markets is that they're not students of markets, they're not a student of the history of markets. They don't understand that the market existed long before they entered. People's approach is based around recency bias. What that means is people say to themselves, well, my today is like my yesterday, therefore my tomorrow will be like my today. There will be nothing different. They don't understand that markets have this nasty habit of going up and then they go down. And the problem is, if, let's take the example of the US market. If you've been a US market investor since 2008, your only experience of the market is that it's gone up. That's the only experience you have. You won't know that in 2008 it went down. You won't know that in 2000 it went down with a tech wreck. Unless you understand that markets have a history that is much deeper than your involvement, you're always blindsided. And in terms of micro features, there is a saying, and the saying is that discipline brings freedom. If you have a disciplined approach to your trading, which means you have a trading plan, it means that you're free from the anxiety that these things occur. You don't feel the upset and the nervousness and the anxiety that people face. I'll give you a recent example. The current unwinding of the yen carry trade that started 3 weeks ago completely blindsided people. And it blindsided people because they believed that Japan would keep interest rates at zero for the next 1,000 years. That didn't happen. They had not in any way, shape or form factored into their psychology, their history or their plan that that might actually unwind one day and that that would come to an end.
So what's your best piece of money advice that you've delivered to somebody of all time?
This is going to sound like I'm one of your parents. If you look in the dictionary, saving comes before spending. Let's think about that from the perspective of trading. One of the good things about markets is that every time you enter a market, it presents you with an opportunity. And irrespective of what people think, the opportunities are infinite. They will continue to be presented to you every day till the moment you die. The problem is, if you have no money, you can't take advantage of them. People's understanding of how to manage money and manage risk is appalling. If you learn to save money, and from a trading perspective that means not letting your losses get away from you, then when opportunities are presented to you, you are in a position to take advantage of them.
I like that. I'd like you to turn to the person beside you and say, what is your best piece of money advice that you've ever received? Tell the person beside you. Okay, let's continue. I want to talk about trading plans next. One of the things with running a trading business is that if we run it as a business, we're more likely to achieve in the markets. If you can think of every single thing that you should put into a business plan and use that as a trader, you're going to be in a very small percentage. Now, the essential trading plan, Chris, this is our next topic for discussion. One of the things I want to know is what are the key elements that should be in a trading plan?
The first thing I'll say is you should have one. If you don't have a trading plan, do not undertake another trade until you get one. Let me give you an analogy. We flew up here on Monday. You wander in, you sit down, you look up the aisle, cockpit door is open. What do you think the pilots are doing? They're planning and they're going through the plan. It's not like they both sat down and went, where are we going? Sydney? Been there before, mate? Once. How do we get there? I think we go to the end of the runway, we turn left, water's on our right, land's on our left. When we see that big bridgey thing, we're there. You need a trading plan, and a trading plan has 3 essential components. It covers your entry, your exit, your position sizing. When you're going to get in, when you're going to get out, how much you're going to risk. And the key component of that is how much you're going to risk. That's the thing. That is the component that drives the rest of it, because that ensures your survivability. And we go back to the original point of that's saving money. That keeps you in the game. If you're not in the game, you can't play.
And what's the one strategy that almost everyone gets wrong?
I only get to mention one, do I? That's a problem. Okay. I've mentioned risk management. That is a problem for everybody. People are obsessed by trading being lots of colourful flashing screens. You're buying this, you're selling that, you're talking to your broker. If you walk around any of the stands here, what they've got open are charting packages and dealing screens. They're nice shiny objects for people. People think that's trading. That's not trading. Trading is risk management. It is deciding how much you are going to risk per trade, and it's very dull. So nobody pays attention to it. But markets are very harsh. If you have no money, you can't play. It's as simple as that. Yes, I know there are FX brokers out there who will take a credit card, but once you've blown that, there's nothing left. The key component of trading is risk management. It is making certain you survive, because markets are harsh in that if you lose 10%, making 10% on your remaining capital will not get you back to where you started from. One of the easiest ways to find out if somebody knows nothing about markets as a commentator is to hear them say, well, the market went down 20%, it's gone back up 20%, it's recovered. No, it hasn't, it's far from recovered, because that's not how numbers work. And it's a sheer sign of ignorance, and you hear it from financial journalists all the time. People get risk management wrong, and they get it wrong because they pay it no attention. If you pay it no attention, eventually you blow the account up. You might get lucky once or twice, as I did when I started trading, but eventually the account goes to zero. And markets are no money, no play. Simple as that.
I like that. Let's have a look at adapting to market conditions. This is an area that I think a lot of people struggle with, because it's much easier to be inflexible with your views, but as a trader we know there is a certain amount of flexibility that is required. So why is it important to understand the market as a whole, not just individual trades?
Markets could be thought of as an ecology. They're interlinked and interwoven. We saw this with the unwinding of the yen carry trade. The contagion was not isolated to simply a movement in yen cross rate. It spread across markets, and it spread across them very, very quickly. That's because markets are interlinked. But the one thing we have to be careful of, and people make this mistake, is to think that markets are clockwork, that if A happens, then B will definitely happen. No, if A happens, B may happen, and it may be a variation of B you haven't considered. Markets are not mechanical, they can't be mechanical, because they're made up of people. Once you get a system that is organic, like markets, it won't have that linear approach, it won't have that linear feel. So you need to be flexible and fluid. Yes, you understand that interest rate policy affects bond markets, affects currencies, affects equities, flows on down through commodities, but you have to understand that's a fluid connection, and it's not clockwork like people think. And it's not clockwork like people think because markets are irrational. They have to be irrational because they're made up of people, which is why AI will have a wonderful time trying to figure out how markets work, because it will have to try and figure out how people work.
So who in the audience is trading their own trading account? Pop up your hand if you've got your own trading account. Okay, this is good. Excellent. So this is directly relevant for you. So what's a key bias that cripples trader results?
Confirmation. Let's imagine I'm thinking about buying BHP. I've actually already made that decision. I'm not really thinking about it, because what I'll do is I'll go around and I'll try and find every source of information I can that agrees with my opinion. One of the things to note about people, and this is a general life lesson, is that when someone asks for your opinion, they don't want your opinion. They want an opinion that matches theirs, so it confirms what they think. This is why social media is so dangerous, because it's an echo chamber. You're fed your own opinion back. Now let's assume I bought BHP. What I will now do is look for every single piece of information that confirms my original decision and makes me seem like I'm smart, because all these other people do it. I can't be stupid, and they can't be stupid as well. This presents a problem because humans are, if anything, defensive of our egos. We act in an ego-defensive manner. We don't want to be wrong. The unfortunate thing about trading is you're wrong a lot. But that doesn't matter, because there's no nexus between making money and being right. Never has been, never will be. Now let's assume my mythical BHP trade starts to unravel and starts to fall. What do? Well, I continue to look for sources of information that confirm my opinion, that reinforce my opinion, because I don't want to damage my ego by admitting that my initial decision to buy BHP was wrong, and then I have to take some form of defensive action. It is this need to have your own ego stroked by listening to others who agree with you that is immensely problematic for traders.
I like that one, but I also like the arrival fallacy. Now,
Yes.
The arrival fallacy is where we think optimistically. We think that in the future we'll be happy if. Now, I felt it when, before I got married, I thought, I'm going to be really happy when I get married. And then people would say, when are you having your first baby? And it's like, I'll be happy when I have my first baby. And then they'd say, are you going to have another one? Yeah, I'll be happy when I have my second baby. And then, just after I gave birth to my second baby, they say to me, when are you going to have another? My goodness me. So we do have to be careful with the arrival fallacy, that we don't think that happiness is in the future, and we have to claim our time now. So that is something I think that is a bias that traders often feel. We think if we can just learn how to trade the equity market, everything will be great. Oh, okay, we've learned that. Oh, options. We have to learn how to trade options next. That's going to be the thing. Oh, all right, I've got options. What about FX? I'm missing out. FX is for me. My goodness.
But that also speaks to the notion of the magic market, that some market possesses some strange intrinsic quality that will make you wealthy. I've had people approach me and say, look, I can't possibly become rich trading because I don't trade FX. Bollocks. Utter nonsense. One of the richest traders I'd ever met, and this goes back to when I was a broker, when I was a dealer, was worth several $100 million. Guess how many instruments they traded? One. You'll never guess what it was either. It was CBA and its options. And that was all he did. That was his specialty. That was the thing he did. And there are no special markets. And this is a real problem for people, in that they jump from one thing to another, to another, to another. What happens is that there's no special market, but you find a market you have an affinity for. Your affinity might be for FX. It might be for options. It might be for indices. It might be for equities. And irrespective of what people will tell you, equities are immensely profitable, because nowhere else in the world can you buy something for 10 cents and sell it for $10. That will never happen with currency, and at a risk of offending people, it's not going to happen with Bitcoin, it won't happen with gold, it won't happen with commodities. But it's you find what you can do.
Let's have a look at the role of support and mentoring. I know for my life, if I hadn't have read the right books and associated with the right people, I wouldn't be doing what I'm doing today. So I want to ask you about this, Chris. How important is the support of mentors and peers in trading success?
Let me perhaps start tangentially by asking a question. Who here's got a microwave? Everybody? You have to reprogram it twice a year when daylight saving arrives. It's a little bit confusing. You push buttons randomly and something magic happens. If you can reprogram your microwave, you can trade. Anybody here can learn to trade by themselves, provided you have 5 to 10 years and incredibly deep pockets, because that's the way I did it. It took me probably, let's put aside, I got very lucky. I first started trading during the 80s bull market. And of course, I thought I was a genius because everything I bought went up. That stopped. And then I had to try and work out what I had done wrong. And the list was endless. And it took probably 5 years post that event to work out vaguely what I'd been doing wrong. So you can work it out for yourself. But in trading, there are no new mistakes. Every mistake you have made or will make, I've already made. So you can generate a shortcut, because someone will say to you, look, mate, I did that 1,000 years ago and it was friggin' stupid. Don't do it. People will still go ahead and occasionally do it, but you have someone who can move you away from that.
So hopefully this has given you an idea that you can convert yourself from somebody who's not psychologically fit into somebody who is incredibly psychologically fit in the markets, because that is our goal. We know the traders that can develop themselves, that can improve their mindset, they're the ones who are most likely to make the most money in the markets. So a lot of this is going to be up to you. I often think the traders that can improve their own mindset are the ones that are going to last as well. Because definitely in my new book, Investing Psychology Secrets, it took me 2 years of research to realise everything is within your own control. The traders that do best in the markets are the ones who actually put their mind to it. So definitely visit us at our website, tradinggame.com.au. But if you haven't QR coded scanned at the moment, definitely enter your details. Somebody here is going to win. They're going to win one of our 2 packs, and it could be you. Those packs are worth over $2,000 and we want you to have them. So get involved and then we'll be able to stay in touch as well. So they're the packs there, just as a quick reminder. Now, are there any questions in the last few seconds that we have
30
available?
seconds.
We'll be around to answer your questions individually, and thank you so much for your time. You've been a lovely audience. We've had the best time presenting for you, and let's welcome to the stage Jasvina.
Thank you.